Hello and welcome to Investing Confidential. Markets gyrating, everyone's focused on the wrong things. They're focused on tariffs, which I told you before, and I'll say it again. Tariffs are a sideshow, folks. This is taking you away from what's really important. Obviously, recession talk. You've got volatility in the currency markets. You've got stock market is all over the place. Bond market is the great equalizer. Almost fell off a cliff not too long, a few days ago. And but again, the focus by the media and it was tariff. Look, you're seeing what's going on with the tariffs today, right? They're a sideshow. It's not really what's important. Okay, what's important continues to be this. This is something that neither administration was going to address, whether it was Harris, Trump, really. They can't because Washington and Wall Street doesn't want them to. They don't want them to. They have made too much money with this, overabundance of debt, printing money. This is how Wall Street makes money. This is how the powers that be, the politicians, the permanent politicians, Washington. This is how they make money. They don't care. They don't care that we only take in, as you can see on the right-hand side, $5 trillion in tax revenue. They don't care that we spend $7 trillion. In fact, they do care because they want to spend. We have a budget deficit of $2 trillion. Debt per taxpayer, $323,000. The income per capita in the U.S. is significantly lower. It's like 70 grand, 60, 70 grand. I mean, this is unsustainable. No, but nobody cares. Nobody cares. Even Doge is not making the impact it did before because permanent Washington doesn't. There's lawsuits. It's a mess. The powers that be do not support Doge. Wall Street does not support Doge. They want spending. That's how they make money. Wall Street's taking on the chin right now. There's no deals. There's nothing. So they can't wait for this to end. So that's why you don't see any of them forecasting recession. None of them. But the real focus shouldn't be on the tariffs. It should be on this, the dollar. I told you before, the election was an inflection point for financial assets and for the dollar. Okay, this goes back to COVID. You see the COVID lows. We had deflation, interest rates going down for 30 years, culminated at the end of 2020 when we had out of control. Finally, people were realizing that it couldn't continue anymore. And all of that money printing caught up to it, and inflation spiked. And when the rates went up, that's when the dollar strengthened, and this is it. That peaked out. So you're going to see, you're probably through the history books, you're going to see the end of 2020 and the beginning of 23 as the top in the dollar. Most likely the top in the United States as well as a powerhouse, but the top in the dollar. That's it. Now, we're at support levels here, so we're probably going to bounce a little bit, but the dollar is on a long-term declining trend. There's no other way. You can't sugarcoat it, folks. And here you see it, the worst start for the dollar's performance for 20 years, in 2005, and it's probably even worse than that. This is a disaster. This is emerging market. This is like what happened to Brazil, Argentina, Asian currency during the Asian crisis. This is a nightmare. But everyone's focused on the tariffs. The tariffs are irrelevant. And so when you have this kind of crazy movements, you have other distortions. And here's the biggest distortion. If I asked you what was the best performing non-dollar asset, you'd probably tell me gold. And you would be wrong. It's the Russian ruble. The Russian ruble. outperformed. Now, gold has significantly outperformed the S&P 500 recently, and even now over the last, I don't know how many years. But look, but again, the distortions. Russian ruble. Why do you think Putin, who's an evil son of a bitch, is not in a hurry to negotiate? He's making too much money. His currency's up 40% versus the dollar. That offsets any kind of movement down in oil prices. He doesn't care. He's making money. Doesn't make money. Now, Trump wants oil prices to go down. But again, here we see the distortions. When you have movements like this, you have insane. This is insane. Russian ruble movement. Insane. But this is the reality of what's going on. You're going to see more of this kind of volatility. And so the current administration, the reality is that in the short term, it's working for them. They knock down oil prices, which they intend to do continue. And so you've got core CPI, which, again, you can argue whether it's worthless, but let's not get into that right now. We know these government numbers are not worth the paper they're printed on. But look at it how it is. Okay, this is called the beginnings of deflation, folks. We're seeing it in the stock market. We're seeing it in real estate outside of New York City, other than New York City. So this is what the administration wants. They need deflation. They need CPI contained because they have other plans. Their other plans are to spend more money, tax cuts, not to address the deficit. But again, the playbook, okay, going back, the playbook is a very simple playbook. It's the same playbook that the IMF gives emerging countries when they got problems. When you have a problem, when you spend more money and you got massive debts, you can't pay your bills anymore. What do they tell you to do? IMF comes in and says, okay, devalue. You need to continue to devalue your currency and export your way out of it. That's their modus operandi. They're a bunch of morons, but that's what they do. So whoever is orchestrating this for Trump is basically doing the same thing. He's doing the IMF playbook. They need the dollar to weaken. They need oil price to go down because they need inflation to be subdued. And when your dollar weakens, when your currency weakens, your debt versus other currencies becomes less as well. That's, again, the IMF playbook. That's how you reduce your debt. You deflate out of it. And the expectations are the complete opposite. So that though this CPI being subdued, look at the expectation. And can you blame people? He's a consumer. Every day, all you're hearing is Trump tariffs are inflationary. That's all you're hearing. So the expectations are sky high. Now, the reality is different. Whether it stays that way may be the same, but this is causing an issue, right? Big issues. And what's actually really happening is deflation. And to a certain extent, deflation is not that terrible for Main Street. Because look who owns all the financial assets. Well, it's the top 1%. They own all the stocks versus the bottom 40% and the middle class. They own much more stocks. So deflation and stock markets in the stock market doesn't really affect people. Now, in real estate, this is a little chart is kind of confusing here. Now, most people, this real estate by the bottom 20, bottom 40%, that's their own home. And they don't trade out. Most people don't trade out of their own home. So the movement of your house on Zillow is irrelevant. You're not going to sell it anytime soon. But on Wall Street's case, they own real estate, but they trading it. And they're leveraging it. And they got problems coming up. Major problems. So again, the deflation of Wall Street and deflation of financial assets is actually not a bad thing for Main Street. It's not good in general, but it's not a bad thing. And then the other positive thing is this wealth effect. You're having a negative wealth effect. You have people constantly complaining. Oh, the wealthy own this. It's all fictitious. It's stock market gains. It's paper money. The wealth effect is wide because of paper money, but that's changing. Look how fast it changes when you lose $8 trillion in the stock market. Right? Wealth effect shrinks, becomes less. That's a good thing. Just saying, in terms of Main Street, it's a good thing. So that's, again, a consequence. So the dollar weakening, we've got deflation. The next question really becomes is, what does it mean for recession? And again, these are the betting markets, because Wall Street is never going to tell you that we're going into recession. But if you're middle class, if you're what they could call you've been in recession. We've been in recession for 4 years. In fact, I'll make a case that this recession is going to be a recession of financial assets, of Wall Street recession, and that the Main Street will begin to come out of their recession at some point sooner than Wall Street. Meaning your economic situation will get better while the stock market remains volatile and in the toilet bowl. So the betting markets are telling you recession is most likely, and it's, as we know, it's happened already. We're in recession, but this is, again, government numbers. Now the other thing is Powell. So the betting markets were rising pretty rapidly that Powell was going to be out, not a lot, almost 30%. But with this comment that Trump made today, Powell's not going anywhere. Trump can't fire. He knows that. So he had to make that comment. Is that a good or a bad thing? I'm not a big fan of Powell. If anyone, for the few of you that watch my videos, I'm not a big fan of Powell. He's in the pockets of private equity, but he's worried about his legacy. He knows he made a policy error last year by cutting rates. That was before the election, major policy error. Now, when we talked about expectations of inflation versus reality, inflation is going to continue to remain high throughout this year and probably come in next year. And that's when most likely the Fed's going to be able to act. But until then, in the short term, they can't. They can't. They're not going to bail out the markets anymore. This is not the Fed put. But Powell's staying. It's a stabilizing force. If Trump would have ousted Powell, that would have been a nightmare for the dollar and for the bond market. I think the bond market, the 10-year bond, getting whacked out this year, or a few days ago, was the main reason why Trump has had to tamper down his rhetoric on Powell. Still doesn't like Powell, still likes him to go, but it's nothing he can do. Powell's here to stay, which is a good thing. I don't like Powell, but I do like the independence of the central bank. So, again, this whole volatility is not good for stocks, not good for financial assets. But again, the positive thing is Powell is not going out despite being incompetent, because he is incompetent. And when it's all said and done, we talked about, what do you do? Well, in the short term, you probably don't want to buy more gold here. Gold is overbought. Given, again, we've had a lot of rhetoric coming out about tariffs being a sideshow. Gold may come in a little bit. It's way overstretched. I wouldn't initiate new positions. If you're a trader, I would take profits here. But gold's overbought. But going forward, like, what can you buy? Well, as we spoke about, you've got to have money in non-dollar assets like emerging markets, like some selective developed markets like Japan, the UK. Commodities, outside of gold, commodities, not oil. Not oil. Stay away from oil, because Trump's going to knock oil down to 50. And so all this volatility, markets up 600, down 1,000, it's just noise. If you hold on, you'll have an opportunity to get out. But overall, the S&P, what S&P told you is the easy days are over in terms of making money just buying the S&P index. Easy days are over. And the dollar will probably spike a little bit here, but then will continue its decline. The secular decline. It's called a secular decline of the dollar. That's what's going to happen. And again, not good. If you think inflation was bad, where do you see what deflation is going to be like? Ask the Chinese. They're just now stabilizing. They've got serious economic issues. And by the way, China beating us in a trade war? Come on, man. First of all, trade war is stupid. Second of all, the Chinese economy is shot. I've heard some pundits today, somebody saying the Chinese economy was strong. No, the Chinese economy is shot. It's probably bottomed out, but there's no growth. It used to be real estate. Real estate is still shot. So their main engine for growth is shot. So China's been buying gold, selling treasuries. We know that. But they're not going to overtake us in a trade war. First of all, trade war is insane. Second of all, it's not going to happen. But remember this. If you're an investor, you've got to look at non-dollar assets, be very selective. There's ETFs out there that can help you. But the U.S., I'm not so sure. U.S. assets, Wall Street. Wall Street's done. You can put a fork into it. They're done, which is a good thing. But again, tariff volatility will continue. There's going to be a real recession. Okay, there has been for most of the population, but across the board recession is baked in, is going to happen. And financial assets will go lower along with the dollar. So where can you hide? As I mentioned, non-dollar assets, emerging markets, commodities. But no matter what you do, investors, be careful out there.